Hi everyone, today we're going to present about a scenario of US companies relating to a well-known accounting trick called Big Bath. Due to various global issues such as the ongoing effect of the COVID-19 pandemic or wars in Ukraine, several CFOs of US companies are writing up assets in response to the negative impacted performance of the companies. However, there's a serious concern that the Big Bath is undertaken to preempt all bad news through one-time impairments to high persistence headwinds. Therefore, the companies are recommended to depreciate or amortize their assets based on a prescribed schedule instead of implementing such an ethical accounting trick. Firstly, we'll talk about what is Big Bath and its real-world example with the benefits and consequences. The second key point is the main advantages of gaining managers the flexibility to track impairments on assets. Then, the main advantages of requiring companies to depreciate or amortize their assets according to a prescribed schedule. Finally, we will express our view in a response to which approach is preferable from regulatory perspective. Now, let's start with what is the Big Bath, presented by Jaden.
Okay, thank you. So Big Bath is an accounting strategy where a company takes advantages of a bad year to write off large expenses and losses in a single period. Actually, there are many real-world examples of Big Bath. Take Aaron, for example. This energy company is famous for its massive accounting fraud. They used the Big Bath accounting method to mask their financial troubles. Aaron took huge write-downs and recorded massive losses, trying to reset its financials before everything fell apart. WorldCom is another example of Big Bath. They capitalized operating expenses and inflated their earnings to look better on paper. When the telecom industry took a hit, WorldCom wrote off billions of dollars in assets and expenses, creating a Big Bath effect to mask their financial problems. Although the Big Bath might seem like an accounting trick, it can actually benefit a company in several ways. First of all, companies can use one-time write-offs to get rid of obsolete inventory, bad debts, or other non-performing assets. This cleanup of balance sheet helps create a healthier financial position. Secondly, the Big Bath can provide tax benefits by recognizing large losses in a single period. These losses can offset taxable income, reducing the company's tax liability for that period. Lastly, by recognizing all potential losses in one period, the company clears the slate for future periods, which can then show better performance. This makes future earnings appear more favorable.
Allowing managers this question in setting impairments on assets makes sense for several reasons. Firstly, it can provide a more accurate long-term financial position of a firm. Managers can quickly adjust the value of assets downward when faced with deteriorating market conditions caused by economic calamities, clusters of faulty excels in a car fleet, or shift towards mass transit bike commuters. Among other factors, this enables investors and stakeholders to better understand the true situation and make informed decisions about necessary actions to sustain business operations. Secondly, flexibility in charging impairment helps them better manage their earnings. If firms more adequately recognize impairments in bad years, their future expense will be smaller, and this helps smooth out the firm's earning trajectory over time. We should, in theory, help stabilize the price of its stock, decreasing market volatility and giving investors more predictability. Moreover, this approach can ensure that asset values are more easily reconciled with the underlying economic reality, removing any temptation in pure-play assets at year-end. As a result, financial reporting can become more credible, which in turn should reinforce the credibility of a company's management and enhance investor trust, thus leading to an increase in capital. Collectively, this affords managers more discretion to book impairments, which might in turn contribute to a more nuanced and timely valuation of assets, which in turn fosters financial transparency, investor confidence, and ultimately market stability. Next, please Maggie to present the advantages of prescribed depreciation and amortization schedule.
Thanks, Jimmy. Next page, please. Thanks, Jamie. Prescribed schedules provide a structured methods for valuing assets over time. This helps business manage their finance more efficiently by enhancing the consistency and accuracy in the asset valuations. Also, by following standardized schedules, business promote transparency in their financial reporting. This reduces the risk of misrepresenting assets values, enhancing the credibility with the stakeholders. Further, standardized schedules enable stakeholders to compare financial performance across different companies easier. The comparability supports informed decision-making by investors and other stakeholders. By using prescribed schedules, business can predict further asset depreciations and amortizations express more accuracy. This improves the reliability of the budgeting and the forecasting process. The schedule aligned assets valuations with their actual usage and decline over time. This ensures that financial reports accurately reflect the economy reality of how assets contribute to business operations. Lastly, compliance with the prescribed schedule helps business adhere to legal and regulatory requirements concerning financial reporting. Hence, it reduces the risk of non-compliance penalty and enhance overall reporting integrity. Next, Belinda will express the view from the regulatory perspectives.
Thanks, Mikey. From regulatory perspectives, it may be more preferable for businesses to utilize a predetermined schedule for depreciation. As stated before, a uniform technique can allow for a better comparison of the firm's financial performance over time, allowing management to evaluate current practices in a standardized manner. Depreciation and amortization are expected to be delivered steadily over the estimated asset's useful life. Fixed schedules can simplify the accounting process, as it does not require impairment to be manually calculated, decreasing the risk of error. This can allow regulators to easily monitor compliance with regulation when auditing financial reports. This method is preferable as it restricts managers from manipulating impairments at their discretion. Managers may misuse this power to achieve other financial targets and present the cash flow in a more preferable way to shareholders. A predictable schedule enhances transparency and benefits all stakeholders as it is clear and reliable. The International Financial Reporting Standard, IAS 16, requires both tangible and intangible assets depreciation basis to align with the prescribed schedule. With this in mind, it may increase complexity for a company if they are required to constantly shift between the two methods. In conjunction, the Australian Accounting Standards Board 116 and 138 aligns with the IFRS, requiring a systematic method of calculating depreciation and amortization. Therefore, from a regulatory perspective, it will be of interest to the company to utilize a consistent method of depreciation and amortization according to a prescribed schedule rather than granting managers the flexibility to charge impairments. Now I'll pass it on to May.
Thanks, Belinda. To sum up our presentation, while Big Bets can assist the companies in facing into serious financial difficulties, such as cleaning up the balance sheets and reducing the future costs during the economic recessions, such an ethical accounting trick potentially brings negative effects on the long-term performance of the business, as is real-world example mentioned previously. Therefore, requiring companies to depreciate or amortize their assets according to a prescribed schedule are more preferred from regulatory perspective. Due to their significant advantages, for instance, enhancing the reliability, accuracy, and credibility of companies' financial statements, as well as the predictability in budgeting and planning for the long-term strategies. That also leads to the end of our presentation. Thank you for listening.